All right. Hello, everybody. Welcome back to another episode of The Market Close. This one's a little late. Actually playing into the meme today of being late. It's about 30 minutes late. Had a bit of a technical difficulty is what we'll call it today. We'll talk about the actual story another day. I'm sure there's a lot of variations of different stories that other people have. But although I missed the market open today because your boy needed some sleep, and I missed the market close, we are still here. We are still live. And I've got a special guest that I think is going to make up for the fact that we missed the market open today and we're late on the market close. And I think that special guest is someone you guys will enjoy for the next 2 hours. You guys have been asking for him to be on the show since about a month ago when he came on. And he's here with me in Vegas. Ladies and gentlemen, Mr. Stock Talk.
What's going on? What's going on? What's going on?
And we got Davis in the back right there. There you go. Davis.
Dave's over here too.
What's up, man? How you been?
What's going on, man? Been good. Been good. Good CES so far.
So
How you guys doing?
We've been in Vegas for the past 3 days together. This is the first time we met. And obviously he was a fan favorite on the show. I've been having endless conversations about the markets with him over the past. I just feel like a better investor having those conversations. How's your trip in Vegas been?
Good, man. It's been good. CES is good. You know, all the tech stocks that we like to monitor all have their own booths. So we'll be going to more events throughout the week. The NVIDIA events were awesome. So that was cool. Good food too. That was a good bonus of being there. I know I tweeted that out. People were like, I wanted more insights than the food being good, but the food was good. Got to see some interesting publicly traded booths yesterday. Probably see some more into the end of the week. So yeah, it's going good so far.
Yeah, I think it's been fun. The NVIDIA stuff was fun. Seeing some of the booths was really interesting. And I think the level of technology here, we'll talk about some of the trends, but obviously robotics was the big thing that was on display. And there's probably a lot of stuff we can talk about in regards to robotics. So for those that don't know Stock Talk, I'm going to link his Twitter right here. Again, he was on about a month ago and he dropped some gems for us. This is the beginning of 2026. For those that don't know, his portfolio returned about 5x last year.
505, yeah.
505%. Obviously, to get those types of gains, you have to put in a lot of work. You have to, quite frankly, not even just options and margin, but you have to put in a lot of research to find the tickers that can actually have those exponential gains when you add leverage to them. And obviously, that can outperform the S&P. So let's get started. 2026, I mean, I'll give you the floor. What are the trends you're looking at, and how are you positioning the portfolio from that 5x you're able to get next year into the foundation of what 2026 could be like?
Yeah, I think 2026 is, it's interesting. Obviously, the bull market is still alive. No guarantees that it'll last the whole year. But for now, all things being equal, the market's going up. It's trending up. We're still structurally speaking, technically speaking, in a bull market, in my view. And it's going to take a lot to change that. And so you dance while the music is playing. And I think for now, you continue to operate with a long bias until the market gives you a good reason not to. And so that's what I'm continuing to do. I think last time we talked about a lot of my positions that I have. A lot of my positions are still the same.
Well, that's the thing. Your portfolio really hasn't changed.
It doesn't change. No, and it doesn't change too often. Like I don't do, there's some other research services out there that share, 100 ideas a year or something like that. I don't do that. I try to rotate, between 20 to 30 names and keep my portfolio between 10 to 15 ideally at a given time. Sometimes it goes beyond that. My focus this year really is on a couple of themes. Energy storage being one of them. Inertia Systems is my second largest position currently. My biggest is Amcor, which
we'll talk about Amcor. Yeah. We will talk about Amcor.
Amcor, I think, was the first stock I talked with Amit when we started Equity Edge. It was the first stock we covered, with P-Lab as well, which did very well. We covered both of those. I don't own P-Lab anymore. Had a monster trade on that into that earnings report. But Amcor I do own. It's my largest position. And then Inertia Systems, which is my energy storage stock, is my second largest. Energy storage, I think, is going to be a continuing thematic in the next few years. I think the acceleration in the need for energy storage, not only for data center purposes, but for all sorts of grid stabilization purposes, I think is becoming more and more readily apparent. Obviously, Tesla is a big leader in energy storage. There's other publicly traded stocks too, like Fluence Energy, which I consider a little bit more of a meme name in the space. Not that they're a shitty company or anything, but I consider it a little bit more of a meme name in the space because of how high beta it is. But in my view, Inersis is the highest quality mid cap in that space, the only battery OEM in the United States, deep ties to the U.S. military and batteries. So that's my battery play and my energy storage play that I'm rocking with. So those are my two biggest positions headed into this year. And Amcor really has been a top one or two weighting for me for almost 6 months now, since September. So still rocking with that one. Today was a great day for the only small cap I own, which is OSS. Well, it's not the only small cap I own. I also have a position in Dragonfly, which is a drone stock, but that's a trading position. But this is the only core position that I own in terms of small, up 20% today, which was nice to see. They had a very, very interesting contract that dropped this morning on testing rugged servers for the U.S. military, especially in military transportables, which is, it's kind of being presented as a niche market opportunity. I think it's more than that.
You think it's a big trend for this year?
Yeah, I think it's a big trend for this year. I think two big trends for this year are going to be edge compute.
Running those LLM queries on the device itself, not to a data center.
Well, that's on device. So there's kind of two facets to it. The first being edge compute, which is just having either mostly inference. I guess at times it can be training, but mostly inference compute that's in a local area or in a transportable area. For example, on tanks, on military aircraft, on autonomous trucks, in battlefield scenarios. In all of those scenarios, you cannot build a clean room server.
Yeah.
Right. Your traditional servers can't be built in those scenarios. They can't be used in those scenarios. And in mission critical applications, things like AI on the battlefield, or for example, AI in applications like air traffic control, or AI in any mission critical applications where failure is not an option, you just can't rely on a data center in Ohio to provide that inference. You have to have fail-safe local compute that's ready to accomplish that objective. Even if you're using, non-local compute in the cloud as a alternative or as a priority, you need to have a fail-safe and you need to have localized edge compute. So that, I think, will be a big theme. I think the driver of it will probably be aerospace and defense, because it's the most immediate application. That's where you need rugged servers.
Your biggest customers there.
Yeah, your customers are there, and also it's just the most obvious application for rugged compute, right? Like it's the one place where you cannot build an Oracle data center. Like if you're, for example, if the U.S. military, let's say, begins more operations in Venezuela, I'm not saying this is going to happen, but I'm just saying, hypothetically speaking, and you wanted to deploy AI systems, I'm talking about like in a future of warfare, not necessarily today, you would need compute on the battlefield, right? You need inference compute on the battlefield, and you need it in aircraft. And, with this new contract that OSS signed today, a lot of it is focused around tanks and their 360 situational awareness program. And so this idea of providing 360-degree situational awareness for military assets, military vehicles, and that's an interesting application. Yeah.
So we're seeing semis as a trend this year. Drones you've talked about. Yeah. Obviously the grid with Inersis, and then aerospace and defense and different applications around edge compute. The market's up a lot this year. I mean, you got screenshots on X, about 30, 40% up year to date. Before we get into sort of like deeper nitty gritty topics, general takeaway of the first week of this market. Is it a clown show? Does it make sense? I mean, I think we love Amcor at 53, but is it happening too fast? How are you thinking of?
Yeah, I mean, look, a lot of stocks are up a lot. I mean, I'm up big this year. It's barely started. So yeah, I mean, there's a lot of parabolic moves to kick off the year. I don't think it's particularly unusual. The first couple of weeks, you're going to see people placing their bets in a way, proverbially speaking, but they're going to be picking up stocks they think they can do well this year. You see a lot of this excitement in the first couple of weeks of January. It's not particularly unusual. Saw a little bit of it last year. It tends to be met by some more discriminative selling in February and in March. But no, I don't find it troubling, the action that we've seen. I think you've seen enthusiastic action in very specific places to kick off this year. But yeah, like you mentioned, with those big themes, I think for me, energy storage, aerospace and defense applications, and edge compute, and then on-device compute, I think is the other one that I didn't touch on. But that one, I think, is going to be a big one as well. I think, and for people that don't know what I mean by that is, right now you're kind of running an AI environment where all the compute is being done at these data centers for AI. And right now, I think we're leaning more into this idea that eventually people will want to run LLMs locally on device, and that a lot of the inference is going to come from on-device compute, right?
Yeah.
So like compute on your phone or compute on a computer, a laptop. That like we want to get to the point where the LLMs get good enough that like for regular queries, you can just run them locally. You don't need the internet. You don't need to send the query to a data center. And so I think that's going to be an emerging theme this year as well. I'm not sure, it'll be big in the front half of the year, but I think in the back half of the year, you'll start seeing mobile chip makers, laptop chip makers. I think you'll start seeing a tailwind for those names as well in the back half of the year.
And I would imagine there would be some applications for defense. We do have this post right here from Trump just now, 2 minutes ago. Our military budget for the year 2027 should not be 1 trillion, but 1.5 trillion. That's why the defense contractors, including Palantir, are up after hours. I mean, you've had a year of the Trump administration. When he says stuff like this, I mean, how are you thinking about the policy application of what Trump says or doesn't say and what it does to your portfolio?
It's a huge thing for me. I think, last year, some of my biggest wins came from just directly playing policy, two of my positions that I still own, Centrus Energy, which is my nuclear play, and Huntington Ingalls, HII, which is my shipbuilding play. But I bought both of these stocks basically directly because of Trump's comments. Now, Centrus I've been familiar with for many years. I traded in the past and owned it in the past. I owned it back in 21. Been in and out of the stock. I sold it at 80-ish, I think, in 24. Bought it back in 96 in May of last year. Stock's now 323 today, so it's been doing well. It's coming back up to the highs now. But this is the only nuclear enricher in the country, right? And so when Trump was pounding the table on nuclear energy and saying we want to bring back a revival of nuclear energy, it's been a long time since we've had a president say that. Now, whether you think that's viable or not is less important. And what's more important is, are you going to see passive multiple expansion as a consequence of the policy focus shifting? And you generally do. And we've seen that now with Centrus. You've seen that with most of the nuclear stocks.
Do you think that justifies an Oklo at its valuation?
No, that's a different story. I mean, I don't own the SMR names because they're pre-revenue, and I can't put my finger on the valuation for those stocks. I'm not saying they're bad investments. I'm just saying, like, at a $10 billion valuation, paying for a pre-revenue SMR company. I mean, sure, I think SMRs are interesting technology, but I just can't wrap my mind around the valuation. Now, with Centrus, is it expensive? Yeah, but it's not a pre-revenue company. And they have a very unique asset, right? The American centrifuge plant that Centrus Energy owns is the only enrichment asset in the entire country. So, $5 billion market cap, you're paying for a revenue generating business. Is it expensive? Sure, but it's not pre-revenue. And it does have an extremely valuable national strategic asset. So, yeah, the Centrus play was straightforward. I mean, that stock has tripled since May, actually quadrupled at the highs, but tripled still where it's standing today since May. And then you look at Huntington Ingalls, which is my shipbuilding play. That was another very, very simple, straightforward play on HII is the ticker. Yeah. Another very straightforward play on, if you click on the 1 year, I mean, it's been just ripping. This is a very straightforward play on Trump's shipbuilding comments, right? Like back in February of last year, he's pounding the table on shipbuilding. And I picked this name up, low 200s. Held it since. The stock's 350 now.
So you have to pay attention to what Trump is saying, essentially.
I don't think you have to, but like different people have different styles. I'm a thematic trader and investor, right? So for a theme-driven guy, policy matters, and then policy intention matters. Like even if you can't get things across the finish line, right? Even if you can't get bills passed by Congress, like executive policy intention matters because it moves the puck. Yeah. And when the puck moves, multiples expand. And so, like, yeah, you can trade these names with multiple expansion alone, or you can find names that you think actually have residual value to benefit from the theme for a long period of time, and then say, look, I want to own them for a longer period. And for me, like with Centrus, like I'm not selling that name,
So when a Trump says what you're looking at right now, how do you register?
Well, I mean, this is just, hey, let's spend more money on defense, which is good for me. I mean, I have plenty of defense exposure, right? I have drone exposure through DPro and Kratos. I have Huntington Ingalls as exposure. So I have plenty of defense exposure. I'm happy to see the defense budget going up. But when I look at something like this, I try to look for the specifics. To me, this kind of tweet is less actionable. Yeah, it's good for defense stocks. Yeah. But I look for the specifics, right? I look for, hey, when he's talking about shipbuilding for 2 months straight, I'm like, okay, I should probably own a shipbuilding stock. I went and did the research. Huntington Ingalls is basically, in my view, the most important mid-cap shipbuilding stock in the country. Not a mid-cap anymore, actually, as of last year's move. It's now large cap, but it's pretty straightforward. You find a pure play exposure where there's a clearly demonstrated policy intention, and either you get multiple expansion for a little bit, or you get sustainable multiple expansion, or you get real earnings growth as a consequence of that policy actually following through, right? But in all three of those scenarios, the stock goes up. So if you pick pure play exposures when policy is very clearly demonstrated in front of you, sometimes people don't want to do it because they're like, it's the obvious trade, right? And if you go back to Trump's first comments about nuclear, it was an obvious trade, but look what the nuclear stocks did.
Yeah.
So it's like, sure, it's an obvious trade, but do you want to make money or not? It's like that's sometimes how simple it is. Sometimes the obvious trade is the best trade.
So let's get into that, because that's been a lot of the dinner table discussions we've been having, this idea of if you really want alpha, it's just not an Amazon. Although Amazon should do well. Thankfully, we've had a nice move.
I own it, yeah.
But it's not the 5-10x, and you don't have to chase the 5-10x, but to even have a potential at finding that. Can you walk through a little bit of your methodology on that? Because I think a lot of the things you've been saying have been insightful in terms of find the niche within the niche, and then find the company that actually benefits from that.
Yes. I think what you have to do is you have to be top down, because it's really hard to be a good stock picker, I think, especially in these cutting edge thematics, without understanding what's happening. Like even when it comes to things like edge compute or data center or nuclear energy or any of these things, if you don't have basic industry knowledge, you might be able to read a Robinhood description of the company and look at the balance sheet, but that's not giving you real context. Like you need to know what kind of margins you should expect in a given industry. You should know, what kind of profitability is normal. You should know what kind of cash burn is normal, what kind of debt loads are normal in an industry. Is it an industry where you should be valuing companies by PE, or where you should be valuing them by ARR, or is it an industry where you should be valuing them by, book value? Like it just depends on the industry you're in to understand the type of valuation lens you have to take, the type of metrics you should be expecting. When you look at an industry and you're like, oh, okay, I'm looking at a group of companies and they operate at roughly a 45% gross margin, roughly a 20% net margin, and then you find a company that's operating at 70% gross margins and 40% net margins. You ask yourself, okay, why are these guys better than the pack? And often you'll find great insights on something as simple as that, right? You'll go look into it and say, oh my God, I get it. They have this really, really compelling product that's allowing them to drive higher margins, that's allowing them to drive higher profitability, right? And then you know how to value the company more accurately, but also what's differentiating them. And then you can go down that rabbit hole and say, what about the product is better? Why are they able to operate at a higher margin than their peers, right? There's usually a reason, and you can find out. And that's how you really start the process of learning companies, as finding very simple fundamental differentiations, and then finding out why they're happening on the product level or on the service level or on the business level. And then you end up with deductions, and that's what helps build conviction. So
that happened with Amcor.
Yes.
Biggest question I'm getting: when are you selling?
Yeah, a lot of people are asking me that. So I got an Amcor at 24 last September. I've done some trimming, but nothing meaningful. The stock has mainly climbed in weighting. It's close to a 20% weighting now for me in the portfolio, which is a huge weighting. I generally don't have positions over 10 or 12%. Amcor and ENS are outsized in my portfolio. They're both about 20% weightings. So between those two stocks, about 40% of my portfolio, which is a lot.
Pretty massive.
And so, yeah, that demonstrates my conviction on those names. Now, what I will say is that selling for me is a game that's more thesis built than it is on how much the stock is up. And the reason I haven't been a seller of Amcor yet is because I think there's a possibility that the revenue expansion and the earnings projections that we're talking about actually come to fruition 28. And I think if the market sees ahead to that and sees a potential doubling or tripling in revenue, I think the stock would actually go much higher. So,
and you think it's realistically a monopoly? Or not actually, but there's a couple of people.
Calling it a monopoly is probably not the right way to put it. What I would say is this, is that it is a peerless operation in the United States. Similar to a lot of companies in my portfolio, like Centrus Energy. It's a peerless operation in the United States. They don't have any other enrichment peers. Huntington Ingalls, we just talked about, peerless operation, right? You look at all the shipbuilding subcontracts, they're on them. So when you find peerless operations, by that meaning they have no domestic peers, it gives you a better argument to keep the multiple expansion, better argument to sustain the multiple expansion, right? And so, and it also gives you an opportunity to capture the benefit from the theme. You know, if chips really are going to come back to the United States,
which is what Jensen has been saying all week.
Yeah, which is what he's been saying all weekend, and which is what Trump continues to say. If chips are really going to attempt to come back to the United States, and you want the angle of onshoring, right, then you need to ask yourself, what are the ways to play that? And in my view, packaging is maybe the simplest and most straightforward way to play it. Not to mention, even outside of the domestication of the chip supply chain, we're already seeing packaging constraints.
Yeah.
So like you're already seeing that before any of this bring the chips back to the United States stuff starts. So TSM Arizona is getting accelerated for a reason. I mean, they are moving fast. They're going to be ahead of schedule. So yeah, I mean,
robotics. What are you thinking of that based on the stuff we saw yesterday? And do you think it's also too early to really have a pure play on it besides Tesla and Amazon?
My issue with robotics is there's a couple of layers to it. So I've tried to find industry automation exposure. I've rotated through a few stocks. GXO I was in for a little bit. I don't own that one anymore. HLIO I was in for a little bit. I don't own that one anymore. I haven't been able to find a spot in robotics that I love. I mean, there are meme stocks in the robotics spaces that people know about. Serve Robotics, Rich Tech Robotics, these like meme stocks that are out there. But
these names really get people excited.
Yeah, they get people excited because they move a lot. I mean, the charts look great. I'm not saying you shouldn't trade them. I actually think Serve's chart looks fantastic. But like if they're good charts, like, I mean, dude, that's a beautiful chart. If you're a technical trader, go ahead and trade these. But for me, I like to have positions where I can build a lot of conviction, and I like to have valuations that I can get behind, and all that stuff. So the difficulty I'm having with robotics is I want a pure play, and I want a mid cap, and all the pure play mid caps are meme stocks. And so I'm just in a tough spot in terms of a high conviction robotics position, but I do want more robotics exposure. I will be buying some robotics stocks. I just have to figure out how to play it. So yeah, I'll probably think about it for about a month and then buy some robotic stocks. But that is going to be an area that I shift to this year for sure. Drones as well. I'm having a similar problem. Like I own AVAV and DPro as trades. AVAV I've mostly scaled out of this week, but those are just trades, right? And then Kratos, that's a longer term position for me.
Like this is up 20% year to date.
I mean, Kratos is ripping. Yeah, I mean, dude, the thing is with Kratos is I have 35 and 40 leaps for Kratos that are expiring in January 2027. So I'll be exercising those most likely. But Kratos is my core position in the aerospace and defense basket. So this is the one defense stock that I do like long term. I think they're going to be the next prime contractor in my opinion. So
Ondas, any thoughts on that one? ONDS.
Yeah, I mean, these stock Ondas,
again, that trades at 150 times sales, but that has all the attention.
Yeah, I mean they have the attention because they're the meme stocks. The group, like, look, I'm not, the ONDS crowd is going to get pissed at me for saying this. They have an interesting technology. They have an interesting counter drone technology. Do I think it is like super significant world changing technology? No. Do I think that the primes could easily compete? Yes. So look, there's many ways to think about a theme. I don't think any of these are bad longs. ONDS, RCAT, UMAC. Okay, like Trump Jr. is on the board of RCAT and UMAC. So it's like you have the meme ability there. The stocks are going to go up a lot when those themes get hot, right? Yeah. And I think the charts look great on all of them, but they're just not stocks at these valuations I want to own. I traded Ondas when it was 10 times lower price, right? And like I made a nice trade on it, got a double on it. Haven't really looked back at it since. At $1 billion valuation, like I'm not going to sit here and hold it and say it's not going to go up, but it will go up if the theme stays hot. If we stay in a bull market, those stocks will go up. But that's not the way I think about stocks. I try to find names that I can like anchor a thesis to and like put extreme size in and sit through them. Names like Amcor and ENS and all those. So yeah, it's not my style, but I get why people like them. They have nice charts and they go up a lot.
How are you playing space next year? And does something like Rocket Lab or ASTS at these valuations, at these levels,
So the space one's another one, complicated one for me. I mean, there are satellite plays that I think are attractively valued. IRDM is one I've talked about. GILT is another one I've talked about. I don't own either of them right now. I have the same problem with the space stocks that I have with the SMR stocks, which is that like just can't stomach the valuations. And look, Rocket Lab and ASTS will keep going up probably into the SpaceX IPO. I think they're probably excellent trades headed into the SpaceX IPO. I think if you want to long them as a trade, Lunar as well is another one. Redwire. I think all these names go up into the SpaceX IPO. If you want to trade them for that reason, go for it. But I think the valuations or any of them are attractive? No, not at all. And that just makes them uninteresting to me as like committed plays. Now, again, you have to decide if you want to be a trader in a theme or an investor in a theme. I think some people kind of tie up their logic when it comes to that. Like I saw a lot of this in 2021, a lot of kids who took stocks out of 21 and they're like, well, I love this stock, and then watch them go down 90% in 22 because they don't understand valuation.
Yeah.
And I still see a lot of that. Like people don't understand valuation. Like, I mean, I'm even just peeping at the chat. I'm not hating on the chat, but I'm even peeping some of the names I'm seeing in the chat. And it's like, I mean, a lot of these are meme stocks. And it's like, they don't seem like meme stocks because they're going up a lot because we're in a bull market. But like when sentiment shifts, and it can shift very quickly, like for those of you that traded through October and November of last year, you would see a pretty big drawdown in a lot of those names, right? 30,
well,
40,
forget that.
Drawdown.
I mean, November we had and look, again, I don't want to piss people off when you say these stocks are trading in a meme-ish way, but in November, S&P goes down 5%. People's portfolios got knocked down 50%.
Yeah.
If we are cocky enough to think a month and a half later that won't happen again, it's just like it's like no, you won't learn your lesson.
And you can make, like, the thing is, people want to buy these stocks because they think you can't make crazy returns on the good stocks, and that's just not true. And that's like what I try to prove with stocks like Amcor and Nebius and ENS and LEU and all these stocks and so forth, which have,
it takes a lot more research.
Yeah, it takes more research, but I mean, those stocks still 3, 4, 5x last year, right?
Yeah.
And so, they weren't the meme stocks of the group, but they went up 3, 4, 500%. So you can find quality names with good stories at reasonable valuations that will go up a lot. You don't have to trade the meme stocks, but for those that want to, I get it. The popular retail names that go up a lot, that have high short interest, that are thematically relevant. I'm not saying they're bad trades. I get why people want to own them.
So you got to see Jensen's keynote. So did I. Earlier in the year, I'm thinking, all right, NVIDIA gets to 220, 230. Maybe I'll start trimming my position. You hear that keynote, you see Vera Rubin, you think, man, it would be a little tough to let go of NVIDIA just given the technology they're putting out there. But the question is, again, valuation. How many trillions of dollars can they add? What are your general thoughts on NVIDIA and how it's going to be either a pioneer for the AI industry and all these other semiconductor stocks, or it's going to be something that can hold them back?
I think NVIDIA wins, the industry wins for now. I think that's still true. You look at these memory plays, Micron, et cetera. You look at their tailwinds. NVIDIA keeps winning. They're going to sell more HBM. They're going to keep winning. And same with the other chip designers as well in the AI space. Like, Broadcom's found a niche now in design, and they're doing well. If they keep doing well, it's kind of a rising tide lifts all boats sort of scenario.
Yeah.
Right now with NVIDIA, because there's such a, like, they're the top of the pile in terms of leading this industry, that they're just dragging the rest of the boat with them. It's a lot like what SpaceX is doing for the space industry these last 2 years, right? Just creating an enormous amount of opportunity for everyone else. So, I mean, look, it's hard to doubt Jensen, especially after hearing him talk these last couple of days. Like, he seems really in control of his own destiny. And
did he make you think the cycle has further to go?
Yeah, he did make me think
yes,
that.
because that's what I thought today.
Yeah. He Jensen's comments this weekend were very, very, I don't want to say bullish, but like from his perspective, they were bullish. And it's tough for me to wrap my mind around, it's just the cycle is going to abruptly end this year and you're going to see a drop off in AI chip demand. That's hard for me to wrap my mind around. So I think what's much more likely to happen is that you have a fleshing out of the competitive nature of industry as opposed to a drop off in industry demand. So I think what's more likely for NVIDIA is that we start seeing competitors emerge, both through Broadcom's AI chip program, maybe AMD's AI chip program, Intel now is trying to start one, although I don't have an incredible amount of faith they'll be that competitive. But I think the other AI chip programs will get some traction. That might impact NVIDIA's gross margins a little bit. But at the end of the day, I think NVIDIA wins, the industry wins still. I think that's still true. And I don't think the inflection where that's going to be not true is going to happen this year. I think it'll take a while for that to be the case, where NVIDIA's performance becomes de-linked from the rest of the AI industry. I don't think we're there yet. I think NVIDIA wins is probably good for the rest of SMH.
So, okay, 2022 midterms, rate hikes, things got ugly. Kind of started the way it's starting now. January 2022, we hit an all-time high in the S&P. Do you think that's possible again in 26 or 22? I mean, obviously anything's possible, but how would you philosophically think of preparing the portfolio, or what indicators would lead you to believe things are going south again?
So, yeah, I mean, we've been 3 years vertical. So, you would like to think that at some point, the music's going to stop. It usually does. But the last couple of corrections / crashes we've had have been very brief, right? Yeah. I mean, you look at
even November. Yeah.
I mean, you look at COVID, V-shaped recovery. You look at, what happened in February with the tariff tantrum was effectively a crash. I mean, the S&P 500 fell off a cliff. I mean, at the lows, the S&P 500 fell to the 50-month moving average, I think. So that was a crash for all intents and purposes. It was a short one, but I mean, you blip back up. The thing that's making me sort of think differently about market cycles now is, and I know the old heads hate to hear this, the markets never change. Don't be that guy that says it's different this time. That's not what I'm saying. I'm not saying that the markets have changed or that it's different this time. I mean, there will be a crash. There always is crashes. But I think what has changed my perspective on cycles is the amount of concentration into short-term volatility that we've seen. I think those last 5 years, you've seen 0DT and weekly options exposure go from 10 to 12% of notional options to 60 to 65%. That's insane, right? And what that's done is it's created this dynamic where the moves are faster in the indexes in a much shorter period of time. Things are priced in more quickly, more rapidly. They're more volatile. You see these sort of fake out reactions and then buy back reactions. We get these intraday fades off the open and then huge aggressive buy candles through the rest of the session. That sort of stuff's not new, but it's happening more frequently than it did in the 5 years before. I mean, I've been trading for 14 years now, but in the 5 years before COVID, certainly was much different, I think, in an attitude perspective in terms of the speed of these events. So I think that's changing.
So you think these things happen quicker?
Yeah, and I think that the recoveries are going to be. I think the shocks to the downside are going to be much more severe.
Yeah,
and I think they're going to happen more easily. You think about it, the tariff sell off, right? SPY fell whatever to 470 or whatever the lows were. I don't remember. That was on just fear. Nothing happened.
Nothing happened. Yeah, the tariffs weren't even legal.
Right, a whiteboard got held up, and then the market just collapsed. So I think that's also maybe the double-edged sword here, which is that, yeah, markets are going to be more reactive to the upside. Maybe the bull markets will last a little longer. Maybe you'll have a little bit more cyclicality to these things, or a little less cyclicality to these things. But I think the breaks will be more severe, and they'll be scarier, frankly. And
do you also think that's because of passive ETF flows that are upholding every crash with a buyer for the dip, essentially?
There's a lot of factors. Passive ETF flows, which are at all-time highs. Margin, which obviously just is always at all-time highs, just goes to new highs all the time because it's total margin. But then most importantly than anything is the notional percentage exposure to short-term options, which is much higher than it's ever been in history. It's not even close, right? I mean, the 0DT tools themselves are actually relatively new in a vacuum. When you look at the usage of them, it has exploded. And so that's going to increase day-to-day intraday volatility in the indexes. And not to mention, I just saw that in the comments, retail is underestimated. That's another huge factor, is retail is a much bigger portion of the market now. And, that is going to play a role as well. Retail thinks differently about stocks, right? Retail is less anchored by valuation. They're more willing to speculate. They have longer time horizons. They tend to be better at holding through crazy volatility. They're more willing to focus on small and mid cap. So there's a lot of different attributes to the retail community that are allowing that to happen as well. So, yeah, I don't I don't ever like to predict the market's going to crash to your original question.
Yeah.
But what I will say is that when market attitudes change, it is very obvious, and it shows up in the charts very, very quickly. And so even without being somebody that's a technical whiz, if you know how to read a basic chart, if you know to look at your moving averages and your volume, you should be able to get a pulse on when the market is in an aggressive, environment and when it's not. And you should be able to get a pulse on that pretty easily with very, very basic technical analysis. And really the cue you should be taking from that is, when do I push the gas and when do I not? And I think that's, if you're a long only investor, like most of you are, I mean, I am mostly a long only investor. If you're one of those people, that's really what matters in markets for opportunity cost, is like, when do you push the gas and when do you not? And knowing that is really just a product of understanding how to read the charts and understanding how to look at the indexes on a 30,000 foot view.
Tariffs get overturned tomorrow or Friday, maybe. What happens to the market?
I can't imagine it being a bad thing, but I don't know. It's tough to say. I mean, I can't imagine the market reacting negatively to that, but that may lead to other policy initiatives that need to be taken that may not be as well received, right? So I don't know.
I don't think it's a dark horse for the market. I think Trump will probably find a different way to implement the tariffs as well.
Yeah.
But I think the market's never liked the tariffs. And it's funny because now you're seeing a lot of different policy applications from Trump that I think are sidestepping traditional methods of negotiations, aka tariffs with foreign policy, which is where we get to Venezuela. Broader thoughts on what that means for the U.S.?
I think the Venezuela thing is really just about oil. I don't think it's about narco-terrorism, but the Venezuela thing is less important, I think, than what the general geopolitical climate is like, which is that it's pretty aggressive right now. And I think the geopolitical climate in general is something that's informing a lot of money flow right now. I mean, you look at the relative strength in aerospace and defense stocks all of last year. I have a good feeling aerospace and defense stocks will do very, very well again this year. And part of that is budgetarily informed, but also part of that is this sort of hemisphere attitude that's now been taken by both the United States. Donald's calling it the Don Road Doctrine. That's what Trump's calling it. And then on China's case, their aggressiveness with Taiwan, right? They just did their biggest military drill ever in Taiwan 3 weeks ago. And then you have the war with Russia and Ukraine raging on as well, which doesn't look like it's coming to an end anytime soon. So you have, 3 theaters of war essentially in 2 different hemispheres where superpowers are exerting authority. And now you have Europe with their 5% NATO defense commitment, right? I mean, all of these things are pointing to more defense spending, more modernization of military, more drones, more modern defense systems, more compute, more AI in defense. All of these things are pretty obvious, straightforward, I think, investment opportunities in the next 5-10 years. And like, for me, aerospace and defense is going to be part of the portfolio for a while. I mean, I had 6 or 7 positions in aerospace and defense beginning of last year. Now I have 4. By the middle of this year, I'll probably have 6 again.
Yeah.
I'll pick up exposure in it again. So I think it's a place you should have exposure. To be frank, I think it's an important place to have exposure.
Data center theme. So guys, we're not covering APLD. I'll cover it tomorrow, but I guess earnings are out and that is up 8%. This one has been going back and forth over the past couple of weeks. Same thing with Nebius, Iran. I mean, what is your general thesis on these names? Nebius was at 103 today, then came back down to 96. Like, what is baked into the volatility of these names, and is it worth holding them if you think NVIDIA continues to show chip demand?
Yeah, well, I own Nebius. I own Nebius at 23. It's a core position of mine. I'm not selling it. I think Nebius is unique from the other data center plays for the particular reason that they have a very, very healthy diversification of opportunity. Yeah. And they have AV Ride, which they were here at CES. That's their autonomous vehicle division. They do autonomous deliveries as well. It's sort of an analog to Serve Robotics, but they also have autonomous vehicles. They actually have them in Dallas deployed currently. I see them downtown Dallas all the time. But they also have Toloka, their AI data business. They have ClickHouse, which is their data observability business, which is a peer to Snowflake and Databricks. That company's worth billions. They have a 28% stake in that.
That just feels fundamentally differentiated from Iran, which is not to hate on Iran, but
I'm not hating.
There's a difference there.
Yeah, there's a difference. Yeah, like and what Iran is doing with physical infrastructure and what Cypher and Iran are doing with their sites with physical infrastructure is a little bit different from what Nebius is doing. But the reason I like Nebius is because they have a diversified opportunity. They have billions of dollars in residual value in investments that are giving you a floor to the valuation, and then you have the Microsoft deal on top of that, which gives you an additional. It gives you a way to value it. Like if you look at Nebius on the balance sheet, you look at the revenues, you're not going to justify the valuation. You're like, they're doing 150 million in revenue. It doesn't make sense.
Not profitable. Diluting.
Yeah, not profitable. Exactly. Diluting. But then you look at it, their investments, the deal flow, and then you're like, okay, maybe the valuation does make sense. So yeah, Nebius I like a lot. I have no plans to sell that one. I mean, I was hoping it would come back into the 50s so I could buy more. I never did, but I own it at 23. I'm not selling it.
You've held Tesla since $18. It's been there for a while.
This is one of my oldest. Well, actually, it's the oldest stock because the first stock I ever bought at the beginning of 2013 was Adobe, and then the stock I've held the longest was Tesla. I don't own Adobe anymore, but the stock I've held the longest was Tesla, end of 2015 to now. So yeah, it's been over a decade of holding Tesla.
Did Jensen kill Tesla once again yesterday?
Yeah, I know the autonomous driving thing.
It's becoming a meme at this point. Every time they release something about self-driving, Tesla tanks, but it's like,
yeah, I mean, look, Tesla's valuation today is, I mean, when I bought it in 2015, it was a very different story. I haven't bought any Tesla shares in a very long time. In fact, I think the last time I bought Tesla shares was like 2017. So,
and you think people buying net new shares here?
I don't want to ever say people are dumb for doing that, because there's a lot of opportunity. If Tesla solves humanoid robotics, the stock will go up more. But for me, holding a stock is different than buying it. I know that sounds counterintuitive, and people are like, what's the difference? Like, if you wouldn't buy more, why won't you sell it? It's just not the way I think about equities. Like, I mean, Kratos, I was buying in the 20s. I'm not buying here. Nebius, I was buying in the 20s. I'm not buying here. Tesla, I was buying sub 20 in 2015, 2016. I'm not buying it here. I could go down the list. Like, there's stocks I like that I own at favorable cost-based advantages that in a market crash, if it came somewhere near there, I might buy them. Robinhood, I own at 19. I'm not selling that, but I'm not buying more here either. So it's like, I think about equities as like, you planting seeds, and sometimes you have a mature tree and it's nice to look at, but you don't want to plant another tree right beside it, and that's okay. And I think you can keep rotating exposures like that, and that's how you end up with a portfolio with 10 or 20 names that you have extremely deep cost-based advantages on that you've held for a while, and that's what makes a portfolio in my view. So,
do you think NVIDIA really gives them a challenge on FSD or no?
Yeah, I think NVIDIA is a force to be reckoned with in all of those categories. I mean, now they're wanting to be more competitive when it comes to actually deploying systems, right? And they want to be less of just a pure hardware provider, and they want to be more integrated into the solutions that their hardware is producing. So that's an inevitability. I think NVIDIA is a force to be reckoned with. I wouldn't write them off on anything. But what I will say is that the way Tesla is trying to do self-driving is fundamentally different from the LiDAR approaches. And so where we stand today, there are really only 2, maybe 3 competitive programs on Earth, and those are Tesla, Google, and NVIDIA.
Yeah.
Right? You talk about at scale. And so, and NVIDIA's is really not even at scale yet. It's just, they just announced it yesterday, the Alpha Mayo. But Tesla's approach is different. It's a vision-based approach, and it may or may not work. Like, it's working in Austin right now. I was actually in Austin for F1, the last race a couple months ago, and they were everywhere there. And they were driving people around.
Did you get in one?
No, I didn't get in one. I didn't get in one in the Teslas, but I got in one of the I've ridden Waymos around. But in Phoenix now they're deploying them, the Teslas. So they're moving cities. But the thing is what we really need to find out is, can Tesla deploy at 20 to 30 cities and not need LiDAR? And if that's the case, then that's industry breaking, and you have to rewrite the industry. And if not, then Elon has to come to the table and concede and be like, we need LiDAR. So right now I think it's a 3-horse race, really a 2-horse race if you look at the scale of the programs, Waymo and Tesla.
Yeah.
And then you just have to understand that their approaches are different. They're not doing the same thing.
All right, let's get into some Q&A for the last 20, 25 minutes. So if you have any questions here, you can leave them in the chat. See a bunch of people with some questions. Jose, thanks for the super chat. How would you adjust long call positions given the runs that some of those long calls have been on?
I'm assuming he means he already owns them, right?
Yeah, or I think he's even talking about you have a lot of Amcor long calls. How do you adjust those now that they're so?
Oh, am I going to take the same type of bets? Yeah. So I mean, I'm a conviction trader, so I do a lot of research on my positions, and I just hold. And there are moments where I should be selling or should not be selling. Like with Amcor, for example, I have $30 calls that I bought for $2 that are expiring in June. Stock's 52. I'm probably going to exercise half of those.
No. Then
I have 25 calls that I bought for $3 that are expiring in March. I'm probably going to exercise half of those and sell half of them. So, how do my call strategies change going into a new year? Not really much. I mean, I play stocks the same way. I'm an 80% equity, 20% options guy. So most of my positions, I'm going mostly common stock, and then I add a little juice through naked calls. Like I don't use spreads. The thing that's very different about me from a lot of the other experienced traders you'll see is like I am a risky guy. I don't use I'm not a risky guy in the sense of like, oh, I'm just buying a bunch of meme stocks. I'm a risky guy in the sense of like when I make a decision to buy a stock, I make it with conviction. And I size
when you do the spread, you're
limiting you're hedging your upside. And so I don't do spreads. I do equity at a very, very favorable entry price generally, or at least I try to make sure I'm buying. Like the ability to buy stocks at a good price matters a lot. It allows you to hold stocks through volatility. Like I would have been shaking out a Nebius if I didn't own it at 23, or Centrus at 96, or Kratos at 20, or Robinhood at 19, or Tesla at 18, or so on and so forth. Like my cost bases are so deep. The advantages are so deep that when stocks go down 30, 40%, I'm like, I'm still up 300%. What does it matter? Yeah. And so it's much easier from a psychological standpoint. And again, I get pushback from this from people who say, well, if I'm up 100 grand, if I give back 50, isn't that the same thing as being down 50? And it's like, sure, but psychologically it isn't.
Yeah.
And you're a human operator, right? I mean, I say this for now, because maybe in 10 years you won't be a human operator, but like for now, you guys are human operators of your portfolio. You're operating your portfolio with psychological limitations. You're a person. You have fear and greed and FOMO and all those emotions that cross the table for you. So if you don't try to control for the psychological component, you will never be a good trader. I genuinely believe that. A good trader or investor. And I think it's the people who don't control for the psychology because they think they're like better than thou or something. And they're like, oh, well, I'm not I'm not emotional about my stocks. I don't need to do that. I don't need to prepare for the eventual psychological impact. You do. And when you do things like buy stocks at the right prices or do a lot of research or any of these things that build conviction, they allow you in those moments to maintain confidence. And not like in November, I can't count how many people who loved stocks were like, oh, I got to get out now. It's down 50%. Oh, I thought you loved it. I thought you did all your research, right? But it's a wonder what price can do to change sentiment. Now, I didn't get shaken out of shit in November. Why? Because I own everything way lower. Like I had friends of mine who bought Nebius. It's like 90 or $100. They're like, oh man, I don't know if I can hold Nebius through this. I'm like, dude, I own it at $23. I don't care. Let's send it back to 50. Maybe I'll buy more. And so that's the difference. Is like it gives you a huge psychological advantage. And as long as it's you running your portfolio and not an AI, which might be different 5 years from now, but for now, until then, you have to protect the psychological component of portfolio management, in my opinion. So yeah.
Zeta, a lot of people asking about it. General thoughts?
Yeah, I mean, I got shaken out of the calls I was in. I like the stock. I got shaken out of the calls I was in. I thought Ronnie gave a great pitch when we hosted him on Equity Edge. So I did get into some calls with him when he gave us that pitch, but I got shaken out. I have rules and
so let's talk about that, because I thought this was the most interesting thing you said. You don't bag hold companies.
No.
What do you mean by that?
So there's another thing where I think this is like a thing that has been misinterpreted by a lot of investors. There's this thing on Twitter where investors don't want to be called traders and traders don't want to be called investors. It's a weird thing. I don't get it. And it's like this, it's like they're encamped on both sides.
By the way, Davis is knocked the fuck out. This guy was like, oh, I want to be on the street.
Just crashed on my couch. That's funny. But
it's a comfy couch.
Yeah, it is comfy.
But if a position goes against you, you're done with it. You're not holding.
Yeah. So I want to give this context. So there's this demonization of like investors versus traders, and I think everyone should be both. I think everyone is both.
By the way, it's a real thing. The amount of messages I see every day saying, "Oh, that's a trader mindset, not an investor." It's almost like it's stupid. A sin to trade something and not hold it long.
The reality is everyone's a trader. Just you have different time horizons, and like this desire to be an investor mostly comes from like a desire to be like committed to these very specific investing principles that people think are like. Holy grail. Example I'll give is like Warren Buffett quotes, right? A lot of people will be like, they'll share the buy when there's blood in the streets, and they'll share the, long-term investors just buy and hold companies. That's how you get rich. Have a 10-year mindset, buy and hold, you'll be fine. That is true for the S&P 500.
Yeah.
Okay. Not for individual stocks. And before you begin to think that you are as good a stock picker as Warren Buffett or Druckenmiller or Lynch, sorry to burst your bubble, but you're not. Those guys are like legendary all-time talents, okay? So you don't want to look at guys like that and read their quotes that you see on that people share on Twitter with the little picture of Warren Buffett in the background, buy and hold, right? And people are like, well, that's my mentality. I'm going to listen to Warren Buffett. That's not how it works. Most of you are buying individual stocks, okay? And individual stocks come and go. A lot of them get delisted. Some of them never recover. Some of them spend 10 years flat. And guess what? It's not always meme stocks either, right? Like, okay, Intel had a great end of the year after the government stake, right? Go look at Intel the last 10 years before that. It's dead money.
Yep.
Right? It was dead money for well over a decade, maybe even 15, 20 years. I don't know how long, but it was dead money for a long time. Pull up Max on that. Like, dude, you made no money for a long time. You could have held it from 2002 to 2017 and basically made no money, right? And like, yeah, this is just, it did nothing for a long time. And if you get into a stock at the wrong time, right, and you hold it for an indefinite period of time, that's not necessarily the right thing to do. If you're not monitoring the story and knowing why you own it and making sure the thesis is intact, and making sure the valuation is still reasonable, making sure you shouldn't be trimming, if you don't do that throughout the entirety of the stock, like that's what it takes to manage individual stocks. So there is an element of management that's necessary, even if you're an investor.
And some companies are generational, which is why they deserve.
Yes, exactly. And you should hold generational companies, companies that you think can benefit from a multi-decade theme that you think are going to continue to win, that you have a great cost basis advantage on. Yeah, you should own those and keep those. I'm not saying you shouldn't keep some stocks forever. You should. Yeah, you should have stocks you keep for a very long period of time. But you should be very selective about those stocks. And the big thing is you should not, if you're an investor, this is like very critical in my opinion, you should not mistake management for being a trader.
What do you mean?
Like if you're an investor and you're managing your portfolio, you're trimming contracts or you're adding back to position or you're monitoring a chart for a good entry point or a good dip add spot. If you're doing these management things, do not misperceive them as, oh, that's for traders. Mm-hmm. I'm an investor. I don't need to know how to read a chart. I don't need to know what a good dip buy entry is. I don't need to know when I should be trimming my contracts or adding leaps. If you care about maximizing the potential and the opportunity cost, you should care about those things. And I said this yesterday, like we were all talking at dinner about this, but the thing that bothers me the most about self-labeled investors, and I'm an investor too, but the thing that bothers me the most about self-proclaimed investors is that they have no respect for opportunity cost. They have no respect for the idea of like, my money is not working for me right now. Could it be working for me somewhere else? And very often they will excuse that away by saying, well, I'm an investor. It doesn't matter that the stock's not doing anything because I'm an investor. Well, there's opportunity cost there, right?
You have to be psychologically okay with that opportunity cost.
Yeah, every dollar you allocate anywhere has opportunity cost, right? Every dollar you allocate anywhere to anything has opportunity cost. It could be somewhere else.
So those Zeta calls, when they went against you, obviously if you held them right now, they'd be doing okay. But your rules are so disciplined. Can you speak to that about like how you will not budge when certain rules are broken?
Yeah. So for me, it's a lot about sizing. So if I size above 5% of my portfolio, I'm not going to hold it back. Period. And that means so entries are a very important thing to me. Technically sound entries are a very important thing to me. So let's say I buy a stock. Let's say I do research, do a bunch of research. I do a bunch of research for all my stocks. So do a bunch of research, buy a stock at a 21 EMA retest. Let's say I'm just giving a random example here. Okay. Stock breaks down the next day, breaks below the 21 EMA retest, knifes 5%. I'll be like, okay, that might have been a bad entry. I'll give it another day to see if it can recover. Next day it goes down again. I'm cutting that stock. Now, some people might say, well, what the hell? That doesn't make any sense. What happened? Nothing changed. You did your research. You bought the stock. It went down 7%. Why'd you cut it? For me, it does not, if I have a thesis on a stock, this thesis is not going to change in a month.
Yeah.
Okay. So if I make the concession and say, I had a bad entry, right? I had a bad initial entry. I'm going to revisit the stock. And sometimes what happens is that the stock doesn't recover. Okay. It doesn't recover technically. And then I don't revisit it. And then I find out, oh, some news story comes out and they're like, oh, this is why the stock was relatively weak. They sold some unit of their business or whatever. And I'm like, oh, okay, well, that's why it was relatively weak. I'm glad I got out. And sometimes it does recover. And I'm like, oh, I missed 5% of upside. But if you really think something's going to be a generational pick for years, buying it 15% higher a month later shouldn't matter.
Yeah.
Right. And to the people who say, oh, why not DCA?
Which is it's a contrarian view that you have.
Yeah, I don't DCA. And that's going to piss a lot of people off too. The thing is a lot of the things that I do to generate the returns I generate are non-traditional, but that's I don't bag hold, I don't DCA. I'm very strict with my entries. I go in with size initially.
AKA conviction.
Yeah, I go in with conviction initially. I go in with size initially, and I'm aggressive. And I usually layer on options. And then if I need to add equity to position, it generally comes through exercise of close to the money options.
Yeah. And you know Chris Camillo. I mean, his strategy very not similar to yours, but very from a philosophical perspective, it's like, this is what I do. I read TikTok comments for 50 hours a week, and then I make a trade. And not a lot of people can invest like that. But I mean, he's told stories about losing lots and lots of money off the weekly call not working out. But the weekly TikTok comments he thought would make the weekly call work out. But he's okay with that because when it does work,
it works big. Yeah.
It works very big.
Yeah. And look, guys, a lot of people I think are misunderstanding what I'm saying. I'm not saying you shouldn't DCA. If you're a person that like works a full-time job and you do invest on the side, yeah, you should probably DCA. It's probably simpler to do that. I'm just saying, as a guy, for my strategy, as a guy who does this full-time, as a guy who does an enormous amount of research for positions, I go in with size on my initial entry. That's what I do. And so when I go in with size on an initial entry, I cannot bag hold, right? You cannot afford to bag hold in that scenario because a small loss can become a big loss very quickly. And so I just don't do that. I rely on my entries to be good. If my entries are not good, I revisit the stock. Simple. And when my entries are good, it becomes a stress-free trade very quickly because of the size.
Bitcoin. Any thoughts on crypto this year? Is it a trade to pursue?
Bitcoin's not a huge part of my portfolio. I have a couple of Bitcoins in a separate account, but it's not a significant part of my net worth or anything. I have good friends that are Bitcoin maxis. How do I think it's going to do this year? I think the relative weakness headed into the end of the year is pretty disappointing for Bitcoin. I mean, it just couldn't get off the mat with a lot of other stuff performing at the end of the year. We made a nice push over 91 headed into this year. But look, I think I view Bitcoin very simply. I view Bitcoin as a speculative proxy to the market, to speculation in general. I think Bitcoin is going to go up if the market goes up. The Qs go up, the speculation stays alive, Bitcoin goes up. That's kind of how I view it. I just view it as a speculation. It's a proxy to me now. There's too much institutional involvement now in Bitcoin for me to view it in a vacuum. I view it as a proxy for speculation and for. I think when it's holding up, you can probably throw darts, and I think when it's weak, I think you got to step out of the way and be a little less speculative.
Okay, so then the follow-up question to that is, if crypto is a proxy towards risk, and you're seeing risk go up on high beta stocks, but you're not really seeing crypto go up, do you have any thoughts on the mismatch for why this thing has not taken off to like Tom Lee's price targets, but Oklo is worth 15 billion? Like, why is it not participating in a high beta rally?
Wait, why is ETH not participating, or why
Crypto,
is it
Bitcoin?
I don't know. It's the thing about crypto that is become more interesting to me is like, I don't know if people are treating it the way they did in previous cycles, where it was viewed as sort of this niche, like, oh, if you know, you know, if you don't know, you don't know.
Right.
Now it's like there's so much institutional involvement in Bitcoin, especially through the ETFs. There's billions and billions of dollars of institutional involvement. It feels like it's just become a risk proxy. And I think that now in this environment, we're in such a thematically rich environment, right? Like, you look at
semis, drones, energy.
Yeah, go back to beginning of 23, right? How many themes have come out? LLMs, data centers, nuclear, robotics, drones, quantum, space stocks. I can go on and on. I probably named 10 themes, mega themes, where the stocks within those themes went up 500, 1,000%.
Yeah.
Right? When you're in a scenario like that, it makes you ask yourself, okay, where does the speculation want to go? Where does the speculative money want to go in environments like that? And I think in the last year, it has gone a lot more to those thematic opportunities, chasing those thematic opportunities. And the thing with crypto is, like, it's lost a little bit of its thematic luster.
Yeah.
Right.
Yeah.
And so it's becoming, to me, a risk on proxy. And it's also becoming a proxy to instability, and becoming a proxy to this massive money printing we're seeing around the world. So I think, look, if you want to play the idea of more military is going to print more money, and there's probably going to be more inflation in the long run, I don't think that that's a bad guess. I think gold and Bitcoin are great ways to play that. I prefer to play with physical gold, but I think Bitcoin's a great way to play it.
And the silver gold rally, you think that's a pursuit of a hedge against money printing, but a better one than Bitcoin, at least perceptually? Like a silver up because we're printing too much money.
Yeah, I think that's probably why. Dude, last year was an everything rally, right? Really. You got gold up, silver up, right? Crypto up, stocks up. So I think that was a reflection of, in some ways, the weakness in the US dollar, in some ways, the reflection of the fact that we're printing endlessly. But yeah, I think precious metals have been and are terrific long, especially as a hedge. If you have a portfolio full of speculative assets, I think owning some precious metals or some Bitcoin as a hedge to that is not a bad idea. Although I don't know if Bitcoin will perform well as a hedge to speculative assets. That's the only concern. I think gold will, though.
Path. This one's getting a lot of love as well.
Path was a big winner for us, 500% winner. I don't own it anymore. I sold all of the big earnings winners that we had. So I had Path, P-Lab, AVAV, all up 500%, sold them all. But I still like them. I still like those stocks.
His name is Vishal, for those that are asking.
Name's Vishal, Stock Talk Weekly.
The whole weekend, I'm like, yo, Stock Talk. He's like, Why the fuck are you calling me Stock Talk?
Evan was too. Evan was calling me Stock Talk too.
Yeah, Evan was like, Stock Talk. He's like, dude, we're friends. We can Davis right there still fucking out there. So this is another kind of conversation I want to get into. This is probably the last topic. Having fun with your life. He's a little bit older. I think 4 years older than me. He's done well for himself. He again, some of you guys know his background, but quit med school because he fell in love with trading, took trading seriously, built a research firm, and now he does this full time. You've been coming to Vegas for the past 10 years, like having fun. How do you think
Vegas,
about how do you think about having fun in life while also trying to, manage a portfolio and live and enjoy the gains that you're receiving? Which in this 3-year bull market, a lot of us have been.
Yeah, it's important to have fun. It's important to have fun. I mean, I think, people forget why they do this, which is like to make money. And then the point of making money is to have a better life. And people kind of forget what they get lost in the game, I think, because it's all numbers on a screen. We've really gamified investing and trading in general. As you know, Robinhood has done that in part, but Webull and all these other companies have done it too. But the gamification of investing has kind of led to people taking a lot of risks that they don't understand that they're taking, losing money that they don't understand they're losing, making money that they don't really understand the magnitude of, and then people forget to enjoy it in the meantime, Yeah. And I think it's a huge part of it, hugely important part of it. You have to reap your rewards. Like last year, I had a monster year, best year of my life, in terms of trading, made the most money I've ever made.
It's funny because, again, people don't believe it. Like he'll be in these spaces and there'll be these like 50-year-olds be like, that's not possible. And he's like, no, it is possible. I know you've been doing investing this way for 30 years, but I like it when people can't believe it because like I see all of his trades as well. And like, it's very, but it also, it says more about their insecurity around thinking it's not possible. And if you know the amount of research someone like Stock Talk goes through, Vishal, keep saying Stock Talk, it's very special because you deserve those gains when you do research.
Yeah, it's worth it. It's worth the trade-off, certainly, for the work. But we're in a unique market these last 5 years where there's a lot of opportunity and it's easier than normal. And so you have to give credit to the environment too. And I always do. I don't want to pretend like, I'm the only one doing crazy returns in this environment. There's a lot of people doing crazy returns in this environment, but these type of environments don't last forever. And so you have to take advantage of them when they're here. It's why I emphasize opportunity cost so much. People think the markets are just like this always. And especially if you're new, a lot of you might be started during COVID or started right before COVID or right after COVID. Markets like this are not normal. And so if you do not seize the opportunity in the 4 or 5 years where you have a market like this, or maybe 6 or 7 or however long this bull market lasts, you'll regret it. You'll regret it when the market stabilizes or slows down. So, have fun, take advantage of it, reap the rewards, lock or someone you love something nice, enjoy it, go on vacations, get the nice suite, and
there's a way to hack Vegas with suites, which is lose a lot of money gambling. And
we're in this nice room and I didn't pay for it, guys. So it's paid for us, but
No, I think it's cool. I really appreciated this trip. I think it was fun. Tanner is in the chat as well. Tanner and I, we were just like a sponge for the past couple of days, just listening to him and trying to, soak up the knowledge. Because again, like everyone has a different approach to investing. Everyone has a different philosophy. The one thing that I take from you, and Tanner is not a big TA guy, but we were talking a lot of technical analysis and just like simple, basic things like the volume profile. He was showing us how Zeta is probably being acquired right now versus distributed. If you just look at some basic volume profiles, the average volume versus what it's been trading at, these are like simple things that anyone can understand. You don't have to be an advanced trader. Those things matter. And my biggest takeaway is if you do the research, you will be rewarded. Yeah. It's just that simple. If you do the research, it doesn't matter if you have $1 million portfolio or a $1,000 portfolio. If you do the research and you pick the right name, your reward, it's just so hard to do the research.
Yeah, and there's a lot of advantages that retail has. And one of the big advantages that you guys have is that you don't need to wait weeks or months to fill a position. You don't need to wait. You're an institution needs to like build into a position over the course of a month. You can buy stocks when you want to buy them. You can sell them when you want to sell them. You have flexibility. And more importantly than that, you have the ability to focus on stocks that are not well covered by Wall Street, right? Like the reason I focus on mid caps, these 2 to 10 billion market caps for the most part, is because they're not well covered. There's not 10 analysts from the industry that are, hunting these companies 24/7 and figuring out everything that there is to know. Instead, if you do a little work, you can find out tidbits or inflection points of the business or in the contracting cadence that indicate to you that something's about to happen and can give you great entries in these types of names. And when it comes to the charting thing that I'm just talking about, I mean, next time I come on here, we can do a charting 101 maybe but the amount of charting you need to know as an investor is very limited.
It's like 3 indicators for you.
Yeah, I don't even really use indicators. You need to pull up your moving averages on your chart, pull up your volume profile, and learn how to read basic candlesticks. And for those of you who are out there as investors who go, I've never needed a chart, I do well without a chart, I hear this all the time. You're just being stupid, because what you're saying is that I'm refusing to use another tool that can make my entries better and my exits better and my trims better and my ads better. I refuse to use it because I've done well the other way. You know, if you have the best offense in the NBA and I tell you, do you want to add Nikola Jokic to your team? And you're like, no, the offense is good enough already. Actually, I don't need it. I don't need Nikola Jokic. You'd be stupid to say that. So, yeah, you could be a good investor already, but basic chart reading 101, not the shit you see on Twitter, you don't need Fibonacci sequences, Bollinger Bands. You don't need any of this shit. You don't need RSI, MACD, none of this, okay? You need pull up your moving averages, 20, 50, 100, 200 simple moving averages, and the 9 and 21 EMAs. Pull up your volume profile and just look at it. And over time, you'll be able to pick up more on what is being indicated to you, areas of support and resistance, where you should be buying stocks, right? I see so many investors, they buy whenever they want to buy. Oh, the stock's up 9% today. I'm adding more shares. Why? You should never add on gap up days, first of all. A lot of you do that. Should never do that. You should be buying on retests of resistance and support that are very, very easy to identify.
And even someone like Druckenmiller uses a lot of charts.
Yes, and this is another thing. Yeah, Druckenmiller. I was mentioning this. Druckenmiller, who in my opinion is the GOAT, and he's an idol of a lot of investors. Okay, Druckenmiller has an interview. He says word for word, "I get 250 charts sent to me every Sunday." Okay, every Sunday he gets 250 charts sent to him. He goes through all of them, and he said specifically in the same interview, "If I have a fundamental idea and the chart is bad, I don't take the idea." That's Druckenmiller saying that. Arguably the greatest trader / investor of all time. Or if you want to lean on Lynch, lean on Lynch. Lynch talks about it too. Or if you want to lean on Charlie Munger, go look up Charlie Munger talking about the 200-week moving average. So if these guys, Munger and Druckenmiller and Lynch, are looking at charts, who are you to think that you're too much of a big shot investor to look at a chart? You know, it's just data. It's just data.
And I think the more data for you, the more conclusive a decision, which again helps with the conviction, which I think is the real takeaway. Like, and that's the biggest thing for me that I want to learn as well is like when you get conviction, and we've had examples of this over either SoFi, Rock Lab, Palantir, like everyone's had their own set of convictions. How do you centralize that? But then how do you find more of those? How do you find more of those names you're that deeply convicted in? I think that's what I've learned a lot from you, which again comes down to, do you want to put in the fucking work? Like, really, do you want to put in the work?
Yeah.
Do you want to stay up at night instead of watching Netflix? And even if you have a job, right? Do you just want to study for 2 hours? That's tough. It's tough for me. It's tough for a lot of people. But I think that is the story.
Yeah, it is. It is.
All right. I think we're done. This guy's still... He's like snoring, bro. He's like actually freaking snoring. We're done. There's Stock Talk. I'll put his link in the chat. He will definitely be on again. So kind of the summary of this is themes for this year: semis, American onshoring, drones, aerospace and defense,
edge compute,
and
on-device compute.
Portfolio still pretty much the same as it was.
Yeah, like I said, I closed P-Lab, closed Path, closed AV for the most part. I still have a couple contracts left that expire Friday. I think last time I talked to you guys, we touched on OSS, right? I already had OSS back then. Yeah. So I had that name back then. I added back D-Pro a couple weeks ago. Other than that, no changes. So mostly from those who watched the last episode when I was on here with them, when was that?
I think
I don't know.
Early November.
It will link it. Yeah, early November. But you probably, is that recorded?
Yeah,
it'll be on the channel. If you want to go back and watch that first one, I went over the whole portfolio with you guys on the first time I was on Amit's show. Maybe next time I'm on, we'll do it again because it might be a little bit different. But
and for those looking for specific tickers that he's interested in right now, ENS, that's a big one in the energy space. Obviously, Amcor he still thinks it's cheap. And then OSS, much riskier, but a smaller cap that
I like a lot. Yeah. OSS is not going anywhere. It's a core position for me, so that one I'll be holding for a while.
All right, that is it, folks. Sorry I missed the market open today. The 2 days of exhaustion finally caught up to me. Got some sleep. I'll be back tomorrow for the market open. We'll talk about the whole Jensen question stuff tomorrow. It was a cool moment, super fun, but yeah, we'll get deeper into it tomorrow and keep going from there. Thank you, brother. Appreciate it. You can see Stock Talk right there on Twitter. And he'll be back on next time.
Peace, ladies and gentlemen.
Bye, everybody. Have a
Take
good
it
one.
easy, guys.